So by way of career, I started out as a bank examiner of all things way back when I came out of school. During the S&L crisis, it was a very interesting time to be involved in banking, especially during that crisis. And I moved on from bank examinations to the Federal Home Loan Bank of Pittsburgh. So there I worked in many different roles in balance sheet management, in funding and investments, portfolio management with Home Loan Bank of Pittsburgh, as the organization really transformed itself, moving away from savings and loans and thrift institutions to commercial banks. And they expanded even further into credit unions and later into insurance companies thereafter. I left the Home Loan Bank and went into private asset management. Spent a few years as a fixed income portfolio manager with a private asset firm managing money for pensions and endowments. And then after that stint, I moved on to Freddie Mac. So I went from the first line to the second line and was involved in building out an enterprise risk management function at Freddie Mac during their restatement. So during that period of time, there was a lot of turmoil at Fannie and Freddie. I was in the middle of that and helping build out enterprise risk function in technology and risk analytics and modeling. And then ultimately, the Great Recession came along, and as you're well aware, Fannie and Freddie went into conservatorship. The organization went through a significant transformation under conservatorship, and that's when Capital One came calling. So I had the good fortune of leaving for Capital One in 2009 and spent 12 plus years at Capital One working in balance sheet management, working on asset liability analytics, building out technology, quantitative modeling at that organization. And ultimately, my final role there was heading the LIBOR transition for the corporation. So during that period of time, we went from being a monoline credit card company to becoming a $425 billion multi-service bank, and it was great to be involved in that transformation. So when you look at my career, I've done a lot of different things. I've done regulation, I've done wholesale banking, I've done asset management, GSE, and ultimately commercial banking. And I've always tried to diversify my skill sets and experiences, and it's with pleasure that I have the opportunity to come back to Home Loan Bank Topeka and the Home Loan Bank system to work with folks like yourselves in the wholesale banking arena.
Jeff, thanks. Here he has a ton of knowledge in all industries, so it's a great fit for us as well. So we're going to do a quick Q&A session with Jeff. Please feel free as we go on to ask questions at any point in time. Our previous two regional meetings, we had a ton of questions. So, but I'm going to kick it off with the first question. But if you have a question, raise your hand, please. So, Jeff, we've seen a lot of change resulting from the pandemic, including historically low interest rates, increased liquidity held by our members, paired with the capital pressure, and changing strategies related to lending and investing. So, how has this impacted Federal Home Loan Bank Topeka's business and performance?
Sure, Jeff. If you look back on the pandemic period, typically what happens during a pandemic is there's a rush for liquidity. So our advance volumes actually grew pretty dramatically during March, that first quarter of 2020. We were at our high water mark in total assets at about $63 billion at that point in time. Now, where are we today as of June 2021? We're at about $46 billion. So our assets grew during the crisis, and they've subsequently decreased over the last year and a quarter to where we're sitting at about $46 billion. And when you look at the decrease in our balance sheet over that period of time, first and foremost, it came in advances early on, but for the most part, our advance volumes have been relatively flat to only slightly declining from June of last year to June of this year. Now, MPF, on the other hand, which is one of our top asset classes on our balance sheet, is actually down in excess of $2 billion over that period of time. And as I said, as an earning asset for us, that has implications because, again, that's an asset that we can fund and hedge very effectively. The other area where we've seen our balance sheet change has been predominantly around our short-term liquidity. We built our liquidity position during the pandemic. We've seen our liquidity position actually decline to the tune of probably $4 billion or so over that period of time. So significant transformation in our balance sheet, and when you look at the home loan bank system as a whole, we've actually fared a little bit better. Our assets are down about 27%, whereas the system as a whole is down about 41%. And there's some institutions that had gone from $100 billion institutions to less than $50 billion during this pandemic period. Now, from a safety and soundness perspective, the home loan bank system and Home Loan Bank Topeka as a whole, we're doing very well. Our capital positions are very strong, 5.5% plus in our total regulatory capital. Our earnings have improved pretty well over the period. 2020 was a little bit of a difficult year, tight year on margins, but that's turned around in 2021. Our net income, our net interest margins have increased pretty well over this period of time, and it's not coming from the asset side, and because we've actually been shrinking over that period of time, but it's really come from our NIM expanding. Our asset yields have fallen, but on the liability side, we have callable debt funding our MPF assets. We've called that debt. We've benefited from short-term interest rates going to near zero. We fund ourselves with discount notes, with SOFR, overnight floaters, and our cost of funds at the short end of the curve has become almost near zero or very low. So the Home Loan Bank of Topeka has done pretty well, and we've actually turned that corner into 2021.
Any questions for Jeff after hearing that? Okay. Mm-hmm. All right, very good. Given your extensive background with the GSEs and commercial banks, what do you see as some of the primary issues facing our financial institutions today?
I don't know if that's me. There's quite a few issues that I look at when I look at financial institutions. Looking at market conditions, your institutions are flush with liquidity. Deposit growth has been significant over this pandemic period. I see asset generation opportunities being somewhat limited in this environment. So a lot of institutions, when you look at your NIMs are under pressure, and there's some challenges around finding asset opportunities. So I think that from a balance sheet perspective is a challenge. And I know all of you are close to the markets and close to the news, but one of the things that I see at this point in time is at the latest board meeting, I usually have a theme in my board discussions. And my theme last quarter was turning the corner. It felt like the economy was turning the corner. And now when I put together my summary for this quarter for the board, I was at a loss for what to title this. And my title was Unpredictable. And so when you look at the landscape that we're in right now, are rates going to go up? Are rates going to stay flat? Is the Fed going to tighten anytime soon? When's tapering going to occur? We have inflation. Is it transitory or not? What about supply chains? I don't know about you folks, but I just moved here from Virginia, and if you go to try to buy furniture, I think some of the furniture is not going to be delivered until December, even into 2022. So what does this all mean from trying to manage your balance sheets? It's just a very unpredictable market environment to try to operate. Other challenges facing financial institutions: technology. In this day and age, I think we all learned that having remote capabilities and having technology capabilities to serve your customers is paramount. So one of the challenges I see facing financial institutions, and even our financial institutions around this room, is how to keep pace. I came from a large institution in Capital One, and we were spending $100 million a year on technology. JP Morgan, these big banks, what they're spending on technology is just a huge dollar amount. How do the smaller community banks and smaller regional banks compete? And I think that's going to be a challenge for financial institutions is tackling the technology initiatives to meet our customers' needs. Another area is people. Now you're seeing remote work, you're seeing hybrid workforces. How do you maintain your top talent in technology, in some of the technical skills in this environment where people can work anywhere? If you look at job postings out there, there's job postings that are full remote. You can work for USAA and work out of San Antonio and Dallas, or you can work full-time remote. And a lot of mid-sized and even smaller financial service firms are offering these types of of working and staff models. So I think even there, finding, retaining your workforce in this environment is going to be a significant challenge. So multiple challenges, both from your own personal balance sheets to the uncertainty of the market environment, technology, staffing. There's a lot of challenges facing institutions in the marketplace.
Thank you. Yeah, uncertainty is the word I hear as I travel around. So yeah, a lot of uncertainty what's going to happen. So do you see any additional opportunities for us, the Federal Home Loan Bank, to help our members moving forward?
Absolutely. Especially, we've offered some advanced specials that members have taken advantage of to try to lock up some term funding. We're still continuing to be very diligent in our work around MPF. I've had the good fortune of doing a couple of these meetings in Colorado and Nebraska and now here in Kansas. And one of the things that makes me feel good is when you have bankers like yourself come up to us and say, hey, look, we would never have done 30-year mortgages if it wasn't for MPF. And the ability to sell those to you, the home loan bank, allows us to take that risk off our balance sheet and provides liquidity for that next loan. So for us, we view MPF as being one of our top assets and want to continue to maintain that presence in that marketplace. And for us, MPF, we have capabilities to fund and hedge those assets in the capital markets through debt issuance, through our hedging strategies using derivatives to manage those risks very well. So for us, we want to continue to be there for our member institutions for the MPF program. And likewise, there is going to come a day when rates are going to rise. And again, I was a former banker. As rates start to rise, banks usually toe the line a little bit on their deposits and their deposit betas. So we want to be there with products that accommodate your funding needs. And so we understand a lot of liquidity in the system now, but at some point we want to make sure that we have our technology and we're working with you personally and understanding your funding needs and understanding your balance sheets to be able to meet your needs going forward when this turns. So we see this as an opportunity really to build our infrastructure, build our relationships, and continue to serve our members in our co-op model going forward.
Excellent. Any questions for Jeff? Please feel free. Yep. Okay, sir.
Little changing the subject. I know you're looking about a lot more transition issues.
Yep.
Obviously key. If we're smaller institutions in here and we were interested in credit sensitive indices over SOFR, or at least for our assets, what risks do you see with us trying to go down that path and make that our official policy?
Sure. So one of the things with and I've worked very closely with the Credit Sensitivity Working Group when I was at Capital One on credit sensitive rates. I think the key challenge right now with the new credit sensitive rates such as Ameribor and Bank Yield Index is the development of market liquidity there. So Ameribor is a exchange traded, so there's activity in those sectors. BSBY, which is the Bloomberg Bank Yield Index, and ICE also has a short-term bank yield index. The challenge I see starting out is the liquidity in those products. Is there going to be hedging opportunities? For us as a home loan bank, we're precluded right now based upon regulation of exploring those types of products. But we've had conversations with the regulators on the topic that we need to have the infrastructure in place and be evaluating how the market is evolving to potentially offer advanced-based products at some future point to meet your needs. Now, as a member institution, one of the things I would suggest is building out your technology capabilities to be able to service that debt. So if you decide to do Ameribor-based loans or BSBY or bank yield index type loans, is building out that infrastructure. The challenge though is there's not a lot of standardization in the marketplace yet. So it's almost like, do I build it with a lot of flexibility and pick the a la carte menu item that is how the market evolves, or do you wait a little bit and see how the products evolve? So I think that the challenge right now is, and what I'm seeing is, because there is not standardization, there's almost an inertia in the marketplace where banks don't know what to do. Do I do SOFR? Do I do prime or something that we're familiar with? Or do we do something in these new alternative credit sensitive rates? So with lack of standards, inertia takes hold. So I don't want, and I know I'm doing a talk in mid-October on LIBOR transition, and I actually have, I'm going to do a plug here. I'm going to be speaking on Wednesday with Kroll Bond Rating Agency on a LIBOR transition. So I think there's a link on the website there. You'll get some good insights from Richard Sandor, who is the originator and pioneer of Ameribor. He'll be speaking in the first panel, and I'll be speaking on a panel with other bankers and with State Street. But they'll give you some good insights on LIBOR transition and the evolution of some of these alternative reference rates. But I think it's going to be a challenge because the market isn't standardized at this point. Other questions?
Now's the time.
Okay.
I know Jeff gave a plug for the October 20th LIBOR discussion. So the link is out there on your website, so please attend that. Any additional comments that you, here's a question.
One last question. I'm going to set you up, but we've got the economists talking later, but Jeff, where do you see the Fed going with these rates? I mean, I know you don't, nobody has a crystal ball, but they're talking more and more that they're trying to start raising rates in 2022, but the 10 years up, almost to 1.5 now, so maybe they're anticipating that, but do you think with everything going on, what's your best guess?
Well, and to be clear, I've learned over my 25 plus years that I don't guess interest rates. The market is a lot smarter than I am. But when I look at the outlook, and you look at the Fed dot plots, and you look at the economic forecasts that are out there, everywhere I look, I see that increase in short-term interest rates seems to be something that's going to be into 2023 or so, potentially late 22 at the earliest, but I'm still pushing out into 23 and beyond. And when you look at those dot plots, it's still a measured 25, 50, 75. I don't see short-term interest rates for 1%. And again, I'm not an economist, so I know our economist friend will have models that do this, but you look at the forecast and you don't see interest rates being above 1% into 2024. And coming from a banking background, until short-term rates get over that 1% or so or start to move higher, most bankers don't increase their deposit rates. Your betas are very low, and there's not a lot of sensitivity in your deposit pricing over that period of time. So my expectation is you're going to see short-term interest rates stay low for a period of time. Now, on the long-term interest rate side, as the Fed starts its tapering programs and ultimately discontinues purchases, and you get maybe a more normal marketplace, I could expect to see the curve start to steepen out and long-term rates rise. I could also expect to see, as the Fed starts to get closer and closer to potentially raising rates, if inflation is more than transitory and we see the economy taking off, you could start to see the curve steepen out rather appreciably over that period of time. Now, what's the flip side of this? Is there going to be another COVID? Is there going to be the Gamma variant or the variant thereafter? We still seem to be on the fence a little bit. Economic activity looks strong, then there's some headwinds that come out of the news. So I think it lends itself to being lower for longer is kind of a theme that we're looking at. Yes?
Kind of a quick question. We talk a lot about the inflation side of the Fed's minimum mandate, but not as much maybe about full employment or stable employment. Anecdotally, when I drive around, I see help wanted signs everywhere. At the same time, we see elevated unemployment. What's the definition of what is as far as the definition of stable employment now? Or do you have people or are we in a transitionary state that these folks on the sidelines are just waiting for businesses to increase their pay to encourage them to go back to work?
Yeah. So I'm gonna leave that to the economist that does that for a living. But just my opinion on that is that I went to Pizza Hut the other day and saw a sign saying we're going to close early because we don't have people to work. We were in Denver for the Colorado Bankers Conference, and the hotel had a sign in the lobby that said, "Our service is not going to be good because we can't find people to work." There was a sign right at the front desk. So I'm kind of befuddled a little bit by the amount of jobs available versus job seekers, and there seems to be this significant disconnect. So I don't know whether it's locale of where the jobs are versus where the people are, or there's still the hangover of unemployment benefits that encourages people not, they may not want to work at this stage. But there is this big disconnect, and as I mentioned, I'm in the market for buying furniture as we moved out here, and when they say they can't find wood to be able to build the furniture, and they can't buy cars because the chips aren't available for cars, and therefore car prices are high, there seems to be this disconnect in the supply of labor and the demand for labor. And like I said, I don't know whether that's geography that's factoring into the play, or is it part of the payments or programs that we have in place that are encouraging people not to work. And the same thing, I don't know that I see that changing anytime in the next 3 to 6 months. It seems like this may be a little bit of a prolonged imbalance where it's going to affect supply chains over that period. Right? But once again, I'm anxious to hear our economist give his take on that question. So we'll put a Post-it note on that one. Any other questions? Happy to answer.
Well, Jeff, we greatly appreciate your time this morning, and glad to have you on board.